People don't realize this, but almost everything you see in the stock market right now is an illusion. When headlines say the market is strong, what they really mean is that a very small group of stocks is holding everything together. Just 8% of the companies in the S&P 500 are responsible for nearly 80% of all returns. The rest of the market is barely moving, quietly struggling in the background. And that imbalance is exactly how major crashes are born. Before we go any further, do me a quick favor. If you care about protecting your money, understanding real risks, and staying ahead of Wall Street narratives, hit the like button and subscribe to StockOra right now. It takes 1 second, but it helps this channel grow and allows me to keep making deep, honest market breakdowns like this. Trust me, you'll want to be here for what's coming next. This video is not about fear, it's not about panic, and it's definitely not about selling everything and hiding in cash. This is about understanding how crashes actually happen, step by step, long before the headlines catch up. Because market collapses don't start with explosions. They start with quiet concentration, invisible stress, and stories that move faster than reality. Right now, 42 AI-related companies are doing most of the heavy lifting for the entire US stock market. These companies aren't just popular, they are essential. They power the chips, the cloud, the data centers, the software, and even the electricity behind modern AI. Names like NVIDIA, Microsoft, Google, Amazon, Meta, and a few others now sit at the center of global investing. Over the last few years, these companies have exploded in size. Together, they've grown from roughly $3 trillion in value to over $18 trillion. Let that sink in. Around 20 cents of every invested dollar on Earth is now tied to just 8 companies. Every pension fund, every retirement account, every index investor is exposed to this same AI backbone, whether they know it or not. And here's the uncomfortable part. Since the release of ChatGPT, the S&P 500 looks strong on paper. But when you remove these AI-driven stocks, the rest of the market barely delivered average returns. Many US companies are underperforming markets in Europe and Asia, so what we're really seeing isn't broad growth. It's extreme concentration. Now, concentration alone doesn't mean a bubble. These companies are incredibly profitable. Their margins are high, their technology is real, and this isn't the dot-com era where firms had no revenue. The danger isn't valuation by itself. The danger is what happens when spending grows faster than results. Since 2022, the biggest tech companies have spent over $1 trillion on AI chips, data centers, and infrastructure. That's more money than the Manhattan Project, the Apollo program, and the entire US highway system combined. And unlike past tech cycles, this spending isn't slowing down. It's accelerating. Some companies are now spending more than half of their revenue on AI. They're borrowing aggressively. Long-term debt across hyperscalers has exploded in a very short time. And while the technology is impressive, the financial payoff is still unclear. Most companies using AI today are not seeing measurable productivity gains. Executives themselves are becoming less confident, not more. This is where the real risk begins. Markets don't crash when stories are exciting. They crash when expectations collide with reality. If earnings don't grow fast enough to justify this level of spending, investors don't need panic to cause damage. All it takes is disappointment. We've seen this before. The metaverse wasn't fake technology. It was real. But the spending came too early, the returns came too late, and investors lost patience. AI could face the same moment. Not because it fails, but because the timeline doesn't match the hype. And if these core AI stocks fall 30 or 40%, the damage won't stay isolated. Index funds fall, retirement accounts fall, confidence falls. And suddenly, what looked like a strong market starts to feel very fragile. But money isn't the only problem here. Even if profits eventually catch up, there's another limit that no amount of optimism can bypass. Power. AI is not just software, it's electricity, massive, non-stop electricity. Training and running advanced AI models consumes more power every single year, and that demand is growing faster than most people realize. Some estimates suggest that just one major AI company could require more power than entire countries currently use. The problem is simple. Power grids are slow. Building new generation takes years. Transformers, turbines, and grid equipment are already backlogged. Data centers are being announced faster than they can realistically be powered, and renewable energy alone can't handle constant, 24-hour AI workloads without expensive backup systems. This creates a bottleneck most investors aren't watching. Not chips, not software, energy. If the cost of intelligence becomes the cost of electricity, then the winners won't just be the smartest companies. They'll be the ones with the cheapest, most reliable power, and anyone without access gets left behind. Now add geopolitics to this already fragile setup. Almost all advanced chips in the world are made in one place, Taiwan. Over 90% of the most cutting-edge semiconductors come from a single island. That alone is a massive global risk. And it's made worse by the fact that Taiwan depends heavily on imported energy and food, making it extremely sensitive to disruption. At the same time, China is racing to build its own independent AI ecosystem. Not to beat the US overnight, but to remove dependence. They are investing aggressively in domestic chips, domestic power, and domestic AI infrastructure. Even if their technology is slightly less efficient, they're willing to spend more energy and money for independence. This matters because the more confident China becomes in its own AI stack, the less protection Taiwan's dominance provides. Any disruption in that region wouldn't just hurt tech stocks, it would hit global output harder than the 2008 financial crisis. So when people ask how a once-in-a-generation crash could happen, this is the roadmap. Extreme concentration, massive spending with delayed returns, physical limits like power, and geopolitical pressure at the weakest link in the supply chain. None of this guarantees a crash. The base case is still growth, but markets don't need certainty to reprice. They only need risk to be ignored for too long. That's why smart investors don't just watch earnings. They watch infrastructure. They watch power permits. They watch debt levels. And they watch geopolitical stress points that most headlines avoid. If this video helped you see the market more clearly, drop a comment and tell me what risk you're watching most closely. Share this video with someone who thinks the market always goes up. And make sure you're subscribed to StockOra, because understanding risk is just as important as chasing returns. In the end, this isn't about fear, it's about awareness. Because the best investment you'll ever make isn't a stock. It's knowing when the story is running ahead of reality. And if these core AI stocks fall 30 or 40%, the damage won't stay isolated. Index funds fall, retirement accounts fall, confidence falls, and suddenly what looked like a strong market starts to feel very fragile. But money isn't the only problem here. Even if profits eventually catch up, there's another limit that no amount of optimism can bypass: power.